global environment which is largely weak, India continues to stand out as that one island of growth that people can continue to look at. Even if you take a very conservative view on earnings, we are at about 12% next year. The multiples are at long-term average, and therefore we say that there should not be downside. The risk off can obviously create that downside, which would then bring you into more of a buy territory. But whether there is time correction, whether the Indian market continues to tread water, will depend a lot now on global cues, which unfortunately are very difficult to predict. But if you are a long-term investor, you could start to argue that you are closer to the bottom than away from it. The question, I suppose, is more on the stressed assets in the private sort of corporate-facing banks. We have argued on our research that many of those banks have started, and I'm prohibited from naming stocks specifically, but many of those banks are beginning to get to valuations where much of the stress is priced in. The risk, I suppose, is when you start to see the stock price move up and when the market starts to look beyond. There is no way to argue that, but on valuations, many of the stocks are at levels where much of the potential stress is already in the share price. We do argue that many of these banks are beginning to price in on the potential stress. The timing of investment is something that you can debate.